Welcome back to Turning Hard Times into Good Times. I'm your host, Jay Taylor, and I'm really pleased to have with me a very frequent guest on this show, Alasdair Macleod, who writes a weekly written commentary. There's a written commentary every week at goldmoney.com, and I always enjoy them. If you're really interested in the dynamics underneath the markets, what causes things to happen in the markets, not just the direction of things, but why are they happening? I don't know of anyone better than Alasdair Macleod to help us understand that. So thanks for joining me again, Alasdair, and Happy New Year to you.
That's my pleasure, Jay, and Happy New Year to you and all your listeners.
Well, we hope it will be a Happy New Year. There's certainly a lot of things on the world scene that can cause some anxiety. I know you're over there in England. Things are changing there fairly rapidly as well. You've got Brexit. You've got a lot of immigrants. You've got a lot of things going on. The world does seem to be changing fairly rapidly, and all of that sort of comes together in a way to affect markets, I suppose. But I'd like to focus on a couple of your recent articles that you've written. One you wrote called The Arrival of the Credit Crisis. That was the most, it was in towards the end of December, I think December 27th. And then one you just wrote on the 3rd of this year, Markets Are All About Flows. In another one was October 11th that I'm looking at here. You said, we are on the verge of moving into an era of high interest rates, so markets will behave differently from any time since the early 1980s. I'd like to play devil's advocate to start with here and just ask you, what makes you so sure that we're heading into an era of higher interest rates? Not just, not just a momentary blip up, but something much longer term, if I understand you properly. What makes you so sure that that's where we're headed?
Well, it's a number of factors, Jay. I mean, one is that interest rates can't go any lower. Now, I do not, I will not accept that negative interest rates are realistic. They really are not. If any central bank pushes interest rates into negative territory, then actually what they're doing is they're putting a tax on deposits, and that's the way to look at it. So that's one thing. The other thing which I think is desperately important is that we seem to think that the rate of inflation, I'm talking about the rate of price inflation, right, is in the order of sort of 2-3% or whatever the BEA say it is. It is not. It is closer to 10%. The only reason we accept that 2-3% figure is that we want to believe in it, and we have no reason really to question it. But I can tell you from my own personal experience that over here in England, prices in the last year have really started rising. But of course, it's never an even picture, because I go out to a restaurant and I find I'm paying about 50% more for the same food that I was paying, say, 2 or 3 years ago or 4 years ago. But on the other hand, the price of petrol has fallen. So, when you put all this into an index, you can sort of play around with the construction of it and all the rest of it. And you can fool everybody that the rate of inflation is 2 or 3%. And that basically is what we want to believe. Now, that is fine so long as asset prices continue to rise. And I'm talking mainly about financial assets, but also residential property. We stomach the extra price increases, and we all moan that, of course, prices are rising faster than they say, but basically in our financial decisions we accept that the rate is 2 or 3% or whatever the last figure was. But as soon as the amount of money flowing into financial assets starts slowing and beginning to contract, we then see the wheels coming off the wagon, and we think to ourselves, what is the rate of inflation? Do we really believe this? Is the level of interest rate sufficient to compensate us for the loss of purchasing power of our currency over the time period in which we're putting it out? No, it's not. We're being screwed here. We're being screwed very badly by misleading statistics. Now, as soon as we start thinking that, then we begin to understand that we need far higher interest rates to compensate us for the loss of purchasing power of our currency. Otherwise, we just dump the currency. And at some stage, if they don't put up interest rates enough, or the market doesn't put up interest rates enough, then that is broadly what's going to happen. And that fundamentally is the reason that I think that interest rates are going to rise, and they're going to go considerably higher than anybody in the markets at this moment in time thinks is either reasonable or possible.
Well, certainly government's demand for money, the treasuries in the United States, we're looking at Mr. Trump's deficits. We're looking, I think, Alasdair, right now at something like $22 trillion, or we're approaching $22 trillion in federal debt in the United States. That means that a 1% interest rate will increase our interest expense by $220 billion a year without any additional benefits to the citizens of the United States. It seems to me that, and then we go on with the demographics in the United States, and I suppose some of these same factors are coming to play in Europe and in England, where you have an aging population as well. So it seems to me the demand for money from the United States government, and I would suspect from European governments as well, is also growing very dramatically. Am I right about that?
Yes, you're spot on. And the other thing about it is that we have got this, I know this is something that we have talked about in the past, and it's something you referred to in your introduction. We have a credit cycle, and the credit cycle plays havoc with government finances. Now, where we are in that credit cycle, and I'm sure that you'll come up with questions to pin this down a bit more, but where we are is we are on the precipice, if you like, of a coming crisis. And I think we have seen the top in equity markets. We have definitely seen the top in bonds, though there has been a good rally in bond prices, fall in bond yields, though that is beginning to reverse itself a little bit again. So you've got these counter-trend rallies, but it is clear that we have seen the peak in the value of financial assets. And from there, as they start going down, I think you'll find that that will then feed into the underlying economy. We've already seen in December, loans to industry have more or less dried up. When you look at bond issuance for investment grade loans and so on and so forth, that really has dried up, and consequently there is no new capital flowing into industry. So from the point of view of Main Street suddenly is beginning to be hit quite hard by developments in Wall Street. And consequently, you're going to get a recession. Now, we'll call it a recession. Let's not assume it's a slump at this stage, though I think that is inevitably what's likely to happen. You get a downturn in the economy, then President Trump's borrowing is going to actually rise quite steeply. Mm-hmm. And I think actually that the US banks are reasonably well capitalized to handle that. But what it will mean is that they will draw in their horns a lot more rapidly than, let's say, when they were caught with their trousers down by the subprime crisis. This time, they will see the quality of their loan books deteriorating, and they will try and draw in their horns very, very quickly. So that would speed up, if you like. This is why it tends to crash rather than just gently subside. Mm-hmm. I think the real problem is not so much in America. There I can see the situation which, we touched on about rising interest rates. I can see the banks surviving rising interest rates and interest rates that continue to rise to territory which nobody considers reasonable at this moment. The problem, I don't think, is the American banking system. The problem, I think, is the Eurozone. The Eurozone in particular is undercapitalized to take a rise in government bond yields. A rise in government bond yields yields to a substantial fall in the prices of government debt. The Eurozone banks are all loaded up with government debt. And the reason they're loaded up with government debt is partly because the ECB has been underwriting that debt by with its asset purchase programs, which incidentally came to an end in December. They're now out of the market. So those prices now have got to stand up against further issuance, against outside factors and all the rest of it, without the ECB supporting the prices. So that's the first thing. The second thing is that those banks who have been supporting the government have been doing so very much at the expense of making capital available to businesses in the private sector. So you've got this, you've got no depth in effect in the economy. Now, you're not going to see, I think, a real crisis in the private sector. The crisis is in that relationship between the ECB supporting prices through its bond purchase programs, the commercial banks who are loaded up on this debt, which incidentally has no risk haircut under the banking regulations rules. And thirdly, you've got the governments whose appetite for issuing more debt is, I'm afraid, likely to increase very rapidly against the background of the ECB removing its guarantee on the prices. So you've got this combination of events coming together, which I think early in 2019 could very rapidly lead to an escalation, if you like, of the credit crisis that I foresee. But underlying it is a question of flows. Where the money flows, money is no longer going to be flowing into government bonds in the way it was. That could turn around quite quickly. And so I think that's going to get the crisis going in Europe. Going back to America, what do the banks do? The banks sit there. They see risk escalating on all sides. They try and draw in their horns. So you will find that a stock market rout turns very quickly into a rout on Main Street. And, of course, we've always got that other unknown, the derivatives. I mean, there are enormous derivative positions. Now, a lot of these don't really matter. But when you have counterparty risk with an outfit like Deutsche Bank, which will have to be rescued, let's be blunt about it, there's going to be a lot of uncertainty as to what actually happens to that chain of counterparties in these enormous quantities of derivatives. So putting it all together, I just see, as we're going into 2019, because the amount of money that is being contracted, and incidentally, the Fed is doing exactly the same, trying to reduce its balance sheet. I just see this money being sucked out of, the new money being sucked out of, or no longer being made available to support financial asset prices, and the knock-on effects on the underlying economy are all bound to be negative.
On the real economy?
Yes.
And well, the illiquidity then is what we're talking about again. And as you've pointed out, there is a time to be long stocks. It certainly doesn't seem to be now, but there will be a washout here that will perhaps provide an opportunity again. Or do you see this as something more significant, this bubble, this cycle?
I hope it won't be more significant, but I think there is a big risk that it will be. I have two reference points on this. One is the 1929 experience when the Smoot-Hawley legislation began to be passed through your houses. I think on the 31st of October 29 was the first set of legislation in connection with Smoot-Hawley that went through the House. That was anticipated by the markets. The markets knew this would pass, and guess what? October 29 was an extremely bad month in the stock market because people sold. We had the same thing over America and China, which they're trying to resolve at the moment. I mean, I think on a positive, I think perhaps President Trump has either learned or been educated quite rapidly that this idea of, a trade war is the easiest war to win is not actually quite true. So anyway, that's one point of reference I have. The other is probably less familiar to your listeners, and that is my experience as a stockbroker in the early 1970s in London. The situation was very, very similar. We had a wind up into a market peak in 1972, which basically was a suppression of interest rates. It was the expansion of money into the economy. The economy was flooded with money in the early 1970s, from between 70 and 71. That sort of thing. Interest rates started rising. The result was that the gilt market, which is our government bonds, peaked in the tail end of 1971, and then in May 72, equity markets peaked. Now, from there, we started entering a bear market. And I do remember talking to an industrialist who, I think it was early 1973, and he said to me that business was booming. They were doing so well. They had an order book that they'd never seen, and yet the stock market was going down. What on earth was the London Stock Exchange doing, permitting this to happen? It rather showed his ignorance as to how markets worked, but it was clear that the market was seeing ahead, and it was looking through the boom, as it were. But the reason it did that was because the money had moved out of the stock market into the real economy. We have had that same thing developing gradually, if you like, in really over 2018, maybe from late 2017. Now, the problem in the UK was made worse because we had an oil crisis, admittedly. And in October 1973, the oil price was raised quite sharply. The Bank of England had to raise interest rates to try and curtail the inflationary effects, but more importantly, help the government sell government debt, which was getting stuck. Nobody was buying it. So we had funding dislocation, which is something we ought to bear in mind about 2019. That funding dislocation led to a rise in interest rates in late October 1973. That led to a banking crisis, a property crisis. Commercial property crashed to virtually valueless almost overnight. What we call secondary banks, in other words, not the top big banks, the clearing banks, but the ones which specialized in commercial property lending, went bust. And a lifeboat operation was launched. We called it the lifeboat, basically to try and save depositors in these banks. And the result was that we had a bear market in stocks which lost, including the inflationary effect, 80% from that 1972 high. Wow. Now, I have these two events in my mind. I have got, and I can't get it out of my mind, I've got the 29 crash on Wall Street, and I've got my experience in the early 70s.
The trade war back then, trade war now.
Yes.
And also, so Alasdair, what you saw, though, money was being pumped into the system, and yet rates continued to rise. And I remember that was the case in the U.S. in the late 70s as well. It seemed as though the real interest rates, until Volcker came in 1980, the real interest rates were negative, really, very low or negative. And then, of course, because inflation kept rising very dramatically in the U.S. in the late 70s. And then Volcker came in and put his foot on the brakes and stopped the growth of money, and we had enormously high rates. Do you see something like that happening again in the U.S.?
I think Volcker's task, if you like, to increase the preference for holding money, which is really what it was about, was relatively easy compared to what the central banks face today. I mean, in those days, Volcker put up the rates. I think he hit the peak in about 1980-81. And the result was that the savings and loan industry went bust.
Yeah, that's right.
So it was broadly contained to that one thing. Now, the thing that's interesting is that the growth in money supply didn't falter at all through all that experience. So while you had the higher interest rates, they were still feeding money into the system, one way or the other, to try and stop businesses going bankrupt. But the interest rate dependent business of the savings and loans institutions basically were wiped out. Now, imagine 20% interest rates today. with the level of consumer indebtedness, with the debt trap governments would really find themselves in, the only thing that can happen is to collapse the currency. I cannot see any other way out of that problem. So we hope we don't get that bad, but I'm beginning to see these dangers.
Alasdair, with just about 3 minutes left, you mentioned the debt trap. Talk to our listeners about the dynamics underlying the debt trap, and then what are the repercussions of it with 3 minutes left?
Well, it's very simple. A debt trap is something you get into when you borrow more than you can afford to repay. And
we've been doing that a long time.
We've been doing that a long time, as you rightly say. But as well as that, what then happens, and it's always very unfortunate, you find that interest rates rise, and so what you thought was affordable is no longer affordable. Mm-hmm. And as interest rates rise, then suddenly you can't repay your debts. And that inevitably leads to some sort of moratorium, which either is an agreement between creditors and debtors, or one side goes bankrupt, or both sides go bankrupt, which is the case in the private sector. But when it comes to governments, basically that slack, if you like, or the problem is dealt with by a fall in the purchasing power of the currencies and a loss of confidence in them.
Right. Government can no longer roll over their debts. People lose confidence. They have to print the money in order to pay the bills that they have.
Well, I would just amend that slightly. The purchasing power of a fiat currency can collapse to zero without any increase in its quantity. Mm-hmm. What really matters is the confidence that that paper actually can be used to settle transactions and at a rate which is acceptable to both parties. Okay,
in 1 minute, what should our listeners be doing right now?
Well, the history of all this, when we ever see these things happen, and there's a flight out of paper currency, and I'm not forecasting this yet. I'm just saying that the possibility of it is far greater. Top dog as an asset is obviously gold.
Mm-hmm. That's historically correct. That's what's worked, because gold is real money.
Yep.
Its value doesn't change, unlike fiat money. So I think that's what we need to do. And obviously, goldmoney.com is one place people can go. But more importantly, they can go there to read your commentary every week. Thank you again, Alasdair, for being with us. Always good to have your insights.
That was my pleasure, Ray.